It's that time of the quarter that we'll start getting the earnings, and of course, it'll be kickstarted by IT major TCS as always. Monday is when we are expecting the numbers for the company to be out. But let's discuss the sector as a whole and what really should be the talking points this quarter. Abhishek Bhandari, the senior equity analyst at Nomura, joins us now. Abhishek, hi, good morning. Thank you so much for making time and speaking with us. Well, this time around, I'm guessing the focus will more be on commentary rather than numbers. What are the things that you are watching out, and what's your expectation? Will the commentary really turn cautious?
Sure. Thank you. And, thank you for having me on the show. So look, we expect the companies, commentary to turn decisively cautious. Some of the early indicators for the cautiousness is coming from the fact that the end clients or the Fortune 2000 companies are slowing down on revenues. The guidance what Accenture put out a couple of weeks back also indicates, a meaningful deceleration between the 2 years. Though the good news is that the growth rate might still be better than pre-COVID. In terms of the commentary, I think the companies will start talking more about, clients trying to prioritize cost optimization projects over the long-term digital projects in the near term, given that the inflation is really biting some of the consumer-facing industries more than the others.
Okay, Abhishek, but in terms of the margin profile of the companies, last quarter was exceptionally bad, and the expectation was that that is going to be the worst. Do you expect further pressure on the downside for the margins this time around, or we are going to see a bit of reversal given the wage hikes have normalized?
So you're right, the companies which have given salary increments in Q1 are likely to see a significant improvement in margins. Though I would say the pace of recovery of margins would be lower than the pre-COVID times, given that the attrition levels are still running high. In particular, in the large caps, we think TCS could have almost 100 basis point sequential improvement, and Infi could have around 60 basis point sequential improvement. Some of the mid caps where salary hikes were not given in Q1 and they have their hikes in Q2, they could see a downside of around 90 to 100 basis points, particularly in the likes of Mindtree and Persistent. But overall, I think the bottom of margin is largely made, though the pace of recovery of margins would be slow.
Right. Abhishek, wanted to get in your outlook on the management commentary because that has turned fairly cautious compared to what we saw in Q4 of FY22. Do you expect this kind of a stance to continue into Q2 as well?
I think from a very near-term point of view, I think the management will start talking about, the usual furlough cycle in Q3. Keep in mind, the last 2 years did not really have too many furloughs because of the clients trying to prepare themselves for COVID-related things. And this year we'll likely see a normal, furlough season. To that extent, there would be some slowdown between Q2 and Q3 from a very near-term perspective. From a next calendar year perspective, the companies keep saying that clients, typically finalize the budget sometime in December and Jan. But we do get some early feelers about, what the clients are thinking. I think, we put out a note sometime in early September where we argued, based on our channel checks, that this time around the bite of inflation is actually significantly high. And among the 3-4 subsectors of technology, which could see a lower spending from next year perspective, the technology spending, particularly in IT services, figure in top 4. So definitely there is going to be, cuts in the budgets. There will be more priority given to making more returns out of the investment, particularly around cost optimization. And I think the pressures probably will be more in terms of consumer-facing sectors like retail and the interest rate sensitive sectors like mortgages.
Abhishek, the one thing which I'm guessing, most investors and market experts must be wondering if indeed the attrition or the hiring trends are not at par with what the market is anticipating, would you be reading too much into it?
No, I don't think so. There's always a lag between, the attrition levels and the demand slowdown. I think the demand is slowing down. It's a fact, and attrition typically, slows down with 1 or 2 quarters lag. I think we are kind of toward the peak of attrition numbers, between Q1 and Q2. And do remember, this typically also is the annual appraisal cycle for many companies. And, many young employees go for their higher studies in the Western world. So typically Q1 and Q2 tend to have higher attrition. But as things stand, the way, some of the cloud companies have stopped hiring, they are on hiring freezes. the way the new tech startup has, kind of is going through a funding freeze. There is a meaningful, deceleration in the overall tech demand, and I think that should translate into better attrition numbers from the company's point of view. On hiring part, we've already seen, the hiring numbers being slow on a net basis. On the gross basis, the companies are still sticking to their broad numbers or hire from campuses, which is around, let's say around 40 to 50,000 between TCS and Infy each. I think they're going to honor those commitments. But the net hiring might be slow given that, the demand is slowing down.
Abhishek, we also wanted to get a sense from you, the double-digit revenue growth that we were penciling in for FY23, is that at risk? And for FY24, would we go back to the single-digit revenue growth?
See, look, from FY23 perspective, our thinking is, it's more likely the margin pressures here rather than growth pressure here. I think most of the calendar budget for CY22 from clients are still in flush out mode, which is a good news from IT services point of view, which is why if you look at Q1 numbers and even Q2 numbers, it's unlikely that companies will disappoint on growth, growth figures. However, come next year, I think, we expect the sector's overall growth rate to come down from close to 11 to 12% in FY23 to around more like 9% next year. There will be a disparity between the performance of the growth between the companies. For example, we expect TCS to grow the weakest and Infy to grow the fastest even next year, based on what kind of bookings these companies have been doing. But in context, a 9% growth next year on a CC basis might still be better than pre-COVID numbers of around 7 to 8%.
Thanks much, Abhishek, for taking time out and joining in, giving us a view on the overall IT space, earnings, management commentary, as well as views on mid-cap IT.